Just got a call from my friend Damien, and he says, you were right. And I said, what about this time? Because I'm always right, of course. Kidding, obviously. But he said, you know how you said the property prices are going to fall further? And he goes, I watched the news last night, and they said, yeah, they're going down different places, different amounts, but they're pretty much all going down. And he said, your prediction that it's going to be 40 or plus % is looking more realistic now. Now it's not only me, that many people have been, and I didn't have to quote a friend of mine, Damien. I can quote many of you who leave comments below. Like I said before, the comments are absolutely super educated, and they some of them are over my head. Not that I'm something special. I don't even work in the financial industry, but I learn so much from them. So I read all comments. I don't really respond. Apologies for that, but please comment and continue to do so, because we all learn. We all read those comments. And collectively, we are smarter than just one or two of us separately.
And the double whammy for sliding house prices. Too much supply and not enough credit.
Now, this next interview is with Cameron Kusher. He's from CoreLogic, and he's no stranger to most of you watching this channel. He's often quoted. And CoreLogic is as big as they get as far as the data when it comes to housing. All the data has to be reported to them, or is reported to them. In any case, they have all the data. If you're going to get it or pay for up-to-date data, it's going to be CoreLogic. So when somebody like Cameron speaks, I listen.
Well, the great Australian dream is starting to keep the Reserve Bank awake at night. The 18-month bust in house prices led by the biggest cities is showing no sign of hitting the bottom. Now the Reserve Bank says the price falls have dumped some buyers into negative equity, and that could mean bad news for borrowers, banks and the economy. Cameron Kusher from CoreLogic joined me from Brisbane. Cameron Kusher, the incidence of negative equity remains low at around 2% of all borrowers. Why would the RBA be talking about this now? It must be something of concern to them.
I think it certainly is. That's why it's made its way into the Financial Stability Review. And clearly with property prices falling quite rapidly in both Sydney and Melbourne, the two largest markets, it's a good time to look at that. I think the point to remember is that a lot of people have seen really strong growth in prices over the last 5 to 10 years in Sydney and Melbourne. But now that there is a correction going on in the market, there is some concern that people are going to slip into negative equity.
How realistic do you think that is? I mean, the RBA used some of your data to come up with this particular chapter.
Well, it's clearly something that they've got their eye on, and I think what it's highlighting is that, although we are seeing some price falls, we have seen a big run-up in property prices over recent years, and there are a portion of people that have bought recently and that are potentially going to go into negative equity. But I think they also probably wanted to highlight that a lot of people have owned their properties for many years. A lot of people have ridden this price growth and are still in a comfortable position despite the correction. But they also noted, obviously, that they are banking a lot on the unemployment rate staying fairly low. And if that does remain the case, then they're not too concerned. But as you know, if the unemployment rate does start to creep higher, then somewhat all bets are off.
Let's take a look at the property market's outlook as a whole. We heard from Moody's, if you believe them, that we'll see another 10% off the major markets this year. Melbourne will see 11% plus before starting to regain ground again in 2020. What's your view on that?
Look, our house view is that it's probably not going to be quite as severe as that over the next 12 months. We're looking for a 20% correction overall in both Sydney and Melbourne. To the end of March, Sydney was already down 13.9% from its peak. We expect that the Sydney market's probably going to bottom early to mid-2020, and Melbourne a little bit later than that, late 2020. So we're probably not looking at a 10 or 11% fall this year, but certainly 7 or 8% is what we're expecting again this year. I guess encouragingly, the latest data that we put out showed that the rate of decline has slowed a little bit, but it is still fairly rapid. on the flip side of that, we are seeing a lot fewer new properties come to the market. So I think that vendors are starting to get the message that if you don't need to sell, it's not a great time to be selling, and we are seeing a lot less new stock coming onto the market at this point.
And what about for Queensland and the other major markets?
Well, in terms of Brisbane, we have seen the market here fall by about 1.5%. We are expecting some further moderate falls this year. If we look at Adelaide, the market's still growing. I think it's about 0.5% over the last 12 months, and we're expecting fairly flat conditions in Adelaide this year. The Perth market's down 18% from its peak, and we wouldn't be surprised to see some further declines over the coming months. If we look at some of the other areas, Hobart's been a standout over recent years, but the rate of growth in Hobart is slowing. It was only 6% on an annual basis in March.
Only?
Only. It's still pretty strong, but when you consider it was 13% 12 months ago, so there is that deceleration happening in Hobart, and we'd expect that to continue. It's certainly not as affordable as it used to be. Darwin, prices are still falling in Darwin.
The other major issue that the RBA focused on is a supply glut, and it really picked on Sydney, saying that it is most at risk of this, and the peak of the problem will be over the next couple of years as these large apartment developments come onto the market. How serious do you take this supply glut warning?
Oh, look, there's definitely some potential issues down the track. I mean, keep in mind that in terms of that new property, when you think about it in terms of the overall market, it's still a fairly small proportion. But clearly, a lot of people bought these properties a number of years ago, expecting that the price would be higher by the time they come up for completion. And we're already seeing a lot of evidence of the valuations for these off-the-plan apartments coming in below that contract price, and in some instances, significantly lower. So they did highlight that has the potential to exacerbate the cycle, and we certainly think that it is a challenge. Of course, remember that a lot of these apartments were also bought by people overseas. Developers may increasingly find those people hard to find if the value of that property is lower than the contract price.
And what about the election factor? Now, if the ALP gets in, they've said that they want to bring in the negative gearing changes from the beginning of next year. Do you expect that would spur some buying so that people can get in and take advantage of the grandfathering of that policy?
Potentially. I still think the challenge is going to be that accessing finance is so much more difficult than it's been over recent years. And from an investor's perspective, you're talking about someone that already owns a property, then trying to go and take out another mortgage. And we know that is more difficult at the moment, but it's also more expensive. So you might see a little bit of an increase, but I don't expect that it's going to be a massive rally.
Cameron Kuchta, thank you so much for your time.
Thanks, Elise.
Julia, so we've seen the RBA warn about the housing market, particularly about apartment developments, especially in Sydney and Melbourne. Is there any signs on the markets that investors are worried about property-related or building-related stocks?
Well, building-related stocks have been hit, and I guess if we look across the property sector, investors have had to be very careful where they invest to see the returns. On one side of the spectrum, we're seeing office property doing extremely well, and stocks like Dexus reaching an all-time record high. And then on the other hand, we are seeing the residential housing market very subdued, so stocks like Stockland as well as Mirvac underperforming in that space.
Okay, so whilst this is not a financial advice, the morale of the story is to stay well clear of the downturn in the residential property cycle. Okay, thanks everyone for watching, and we'll talk again next time.